Good morning, everyone. It's good to have a chance to see you, even though you can see me, but I can't see you. I hope things are going well for you. We just spent several days in Tyler and Nacogdoches and Crockett and other parts of East Texas. Good friend of mine, lifelong friend, in fact, passed away, and her funeral was yesterday morning. Her name was Martha Page, and she was 75, just a real sweetheart, and was a bit of a surprise for us. So we made a shortened trip to Tyler and saw about six people, and didn't get a chance to see everyone, and we will set that up again very quickly. But at any rate, just wanted to visit with you a little bit about where we are on the equity markets, where we are on Oak Financial, like I tend to do from time to time. If I were to share my screen with you, I want to talk a little bit about the world that we live in. So this is the last 6 months of the S&P 500, and I want to just say a couple of things. There is a 50-50 chance that we have seen the lowest of the stock market. The other 50% is we may see a retest of this low in the next 6 to 8 weeks. That's really going to depend on several things that I'll talk about in just a moment. So this is what it has looked like literally for the last 6 months. People get their statements, and it turned out that the last statement you got was on absolutely the worst time that it possibly could have been. And so we've got a fair number of phone calls and visits. And people say, I keep losing money, I keep losing money. Well, you haven't really lost money. It literally has been very close to the same bottom going back to March time period, so about 4 months. And that's kind of what I want you to think about. And what I hope in these is that you can pull up Yahoo or Google Finance and look at this, or give me a phone call and we can talk about it one-on-one. But this is not a particularly scary time when it comes to investment. I have my concerns about the economy and about the country and about our leadership, but I've been in this business for 30 years. I've been buying and selling stocks for about 45 years, and I've seen times a lot worse than this in the last 20 years. And so this is not a particularly scary time, and I want to show you how to read and interpret the markets. I want to show you a number here. This is, when you take a look at the bottom of the screen down here, on March the 8th. Now what I've done is, so to show you percentages, the black mark is the S&P 500. That's the 500 biggest companies in America by market cap. The light blue is the NASDAQ. And I'm just picking that because it turns everything into percentages instead of numbers. Now when you see a line that I'm drawing across here, what I want you to take a look at is how many times in the last 4 months the markets have stopped exactly on that line. You can see one there. You can see one there. You can see 2 days here. You can see a little day down, a couple days up, but it comes right back to this spot. We sell off a little bit here for a couple of week period of time, and we come back exactly to the same spot. So what you see happen, this number right here, basically we have seen about 7 or 8 times in the last several months. We had a little bit of drop further, which is right in here, and now you see the same thing. You see basically here on 512, you see this again on 518, 519. You can see it here on 624, again on 7-7, and now we are above that line. We had a little sell-off, and I want to talk about specifics in just a minute. But I want you just for a moment to take a look at the line and look at how many times we are at this number. This is down 13.17% in the last 6 months. That's what the number to the right means. So take a look at, you see it here, you see that number here, you see that number here, you see that number here, and you see it again here. So a couple of things are happening. First off, companies have lowered their expectations tremendously. That's what's caused the market to be down the 12 to 15% or so that it is. Um, Supply chain problems have been a real issue. People can't find things to buy. Many stores like Walmart and Target lowered their numbers, their earnings. They lowered it again 2 weeks later, and Walmart announced day before yesterday they missed their earnings 3 times, and they're saying that they had to basically order things a year ago to 15 months ago to now get it, and it's really not the type of clothing that people needed, so they're having to do deep discounts. All of this is supply chain stuff that will fix itself in time. When companies start building cars again and getting them moved and so forth, you'll see all of that happening, aligning out again in the future. So what I would say to you is this: the reason why we have nice up periods, as an example right here, you can see on 6/16 we were down 18%. We're now down 11. That's a 7% move up in 2 weeks. That largely is coming from one simple thing. Companies have guided their earnings down so low that they're beating them. And so now companies are coming out every day. We're in earnings season, and their earnings were much higher and much better than their lowered numbers. In this kind of world where people are a little bit skittish, if a company misses earnings, they get cut and left to die. And so there are not many people you're going to see, probably less than 25% of all companies will be below their guidance or their estimates. So that's kind of where we're at right now. And so you basically have many companies, 75 to 80%, we're anticipating will beat their earnings. That will cause the markets to move up. Federal Reserve is probably going to raise rates again 75 basis points. It's a very simple thing. The economy was red hot. It was too hot. The housing industry was too hot, and too many other things. The only thing the Federal Reserve can do to slow down the economy is raise interest rates. So you're going to see that happen, and it will be taking place over the next period of time. So what I would say to you is this. One thing that I try to teach people is a stock portfolio is going to grow at roughly 9.5 to 10% a year. That's not coincidental. It's just simple math. It's roughly what companies have to make in order to stay in business. And so when you take a look at, as an example, I have on my chart here the last 2 years. And what you see happen is, in the last 2 years, the stock market is up 23%. This is after the sell-off. So you can see we topped right here on December 27th. We were up 48% in a year and a half. That's too hot. That's far beyond what a market can sustain. So now we have sold off to a place where, lo and behold, we basically are up 23% from where we were 2 years ago. When I take a look at a 5-year number, what do we see? What we see is the S&P 500 is up, even though this is COVID, that was a pretty hefty drop. This is the sell-off that we're seeing here. The simple fact of the matter is, as you can see here, we are up 61% in the last 5 years. If I were to go to 10-year numbers, what you're going to see happen is the market's going to be up 100 to 110% over the last 10 years. That's just a standard number that you're going to see. Most of you are not 100% in stock because your blood pressure can't handle it. So we'll be 50 to 60% stocks, and your portfolio will make 7 to 8%. So I've been doing this for well more than a generation, and that really is how we determine how to allocate and when a person's going to run out of money and when they're not going to run out of money and so forth. Very simple math. About 3 to 4 weeks ago, we went to 20% cash in every one of our portfolios. I talked about this in my last conversation with you, and it was, if this number did not hold, then we would be going a little bit more to cash. And you can see that basically we got down a ways. So we went to 20% cash we are in the process of moving money into real estate. Real estate is a replacement for bonds. We want bonds because they're not volatile. They kick out a specific amount of money. Well, real estate does the same thing. It'll kick out 5 to 5.5%, but we really believe that inflation is going to be with us for the next 4 years probably. Not the 8 to 9% we see now, but more like in the range of 4%. So bonds are going to struggle. What we're going to use as our non-correlated asset class is real estate. So we will be in conversations with every one of you talking about that going uh, down the road a ways. We have moved much more into large companies that pay big dividends and stocks, away from things that have incredible potential growth but are not currently making money. They're not making money now. They have been hit. They're down 50, 60%. If there's any chance that some of the great companies on the NASDAQ will in time need to borrow money, that's an uncertainty because we don't know what interest rates will be. And so we have moved away quite a lot from that. And so that's where we're headed, to basically real estate. We have a little bit of cash, and so if we happen to see a retest of the market, we will find a nice time to be able to put some of that back to work at a slightly lower price. The last thing I want to say is we have spent about 9 to 10 months transitioning 840 families. We're probably 95, 96% complete. What I want to start doing in my next conversation with you is start showing you Black Diamond and how to pull up your accounts and how to pull up some basic reports that we have in place. So that's something that I'm expecting to do. I want to make these videos shorter. I have a great respect for each one of your time, so I'm trying to make them well less than 10%, 10 minutes rather. But I do want to start showing you Black Diamond to help you learn how to get into that. And then afterward, if you need more help, certainly everybody here at Oak is happy to help you with that. So I hope this is some benefit to you, and I look forward to seeing you very soon. God bless.